Let's take a look at housing finance results, which were released yesterday.
Yes.
Now, it's the second biggest lender, posted a 67% rise in pre-tax profit for the first half of the year, 345 million shillings, a strong growth in loans and advances, a 71% increase in earnings per share for the first half. What did you take out of the numbers?
Well, I think it's a cheap stock. It's continuing to see good earnings acceleration. It's well organized. It's playing in a niche where there is considerable demand for finance. That's the mortgage sector. We have a very few number of outstanding mortgages in the country, and I think housing finance has a good low base effect. I like the acceleration. I think Frank's got the place very well organized, and I, for one, think it's a strong counter to be looking at in this downdraft that we've been witnessing that you've just mentioned. So I have no arguments with those results. I think they're going to continue to build, gain traction, and on a forward PE basis, it's looking very interesting. On a trailing, it's probably a little bit expensive versus its peers.
Now, the interest expense increased almost 35% for the first half. This is a big jump, or an even bigger jump in the second quarter. The cost of bond payments has been an issue. Is this cost of debt sustainable going forward?
Well, I think, the cost of money basically has become more expensive in our local markets, and rightly so. The shilling was being punished viciously for the basic inaction on the short-term money market, and we've seen some change in that. Look, it's not going to be plain sailing for the banks. They're going to have to pay more money for their borrowing, but essentially they got huge spreads here in Nairobi. The lending rates are 15.5%. The average blended borrowing rates around 9.5% as we speak. I mean, you can drive several trucks through this. So I think for now it's not a great concern to me. You're going to see some squeeze, as you've correctly noted, but that's to be expected.
The company's looking to tap into the first-time homeowner market with its fixed interest rate mortgage product. Is this an underserviced market in Kenya?
It is very much underserved. I mean, I think last year I saw a number that there were about 16,000 total outstanding mortgages in a population of 40 million. And that number's probably miscounted. I mean, there are probably more, but it's very difficult to track what's a mortgage and what isn't in a way. But essentially, I think this is a sweet spot. Housing finance have honed in on it. They've focused on it. It's a pretty clean borrowing and lending housing business. They're not playing in the bond market or anything else. So I, for one, am constructive about them. And I think that they're aligning themselves with the big players in the housing industry, whether the contractors or the builders or so they're well aligned. I like what I'm seeing. These results confirm that they're getting things right.
Apart from housing finance, we keep on talking about companies that have strong fundamentals and are trading at a discount given the bearish trend we've seen on the market this year. So which counters, apart from housing finance, do you see offering good value at the moment?
Can I just take a step back quickly, if I may? First of all, we had an extraordinary bull market which sort of came to a screeching halt in 2007 post-Safaricom. We then had this very strong rally last year where the bourse rallied about 32%, and we've now given back 15%, so half of last year's rally. The market remains on the back foot. It's trading in a disorderly fashion for the most part, and we're getting these enormous price swings on very little business. So if you're looking to invest in the stock market today, you've got to take an 18-month view, I think, and you've got to pick up the pieces. And going back to your question, where are the pieces right now? What do I like the look of? First of all, I'm very bullish about agriculture, as I've been for some time, but all the commodity prices, soft commodity prices, that's a long-term story. We have PE ratios of 2.5 to 3. We have breakup values of 10 times. And we have companies who are, at the moment, have proven singularly incapable of extracting value. They cannot continue in this vein anymore. I think you're going to see a lot of action around those companies, and I would have a look at those. Looking further afield, something like Kenya Airways on a PE of 4.2 or 4.3, ahead of what is a cash call, looks to me extremely attractive. If you fly around Africa and you pay the ticket price, you'll notice how expensive African tickets are.
But that company is expected to come to the market, though. Could that weigh on the share price?
Well, I think it's already weighed on the share price. I mean, you're here at a P of 4.1. You're within 10% of what I would call a sort of give me price. And I would be having a look at that very, very closely. It's a good business. It's structurally sound. It's showing good underlying momentum growth. And they're looking to expand. You're going to be betting on that expansion. I see no reason not to do that. Something like Safaricom is really a victim of the fact that nearly 1 million shareholders piled into it. And the share price has not recovered beyond that initial price. So that is weighed down by this enormous retail shareholder base who's simply looking for some kind of exit strategy. Again, that looks oversold to me right now. Moving to the banks, you got some very good value situations here. You got something like KCB on a P of 8.4, first quarter earnings growth of about 33%, excellent footprint across the region, cost to income ratio way above its peers, but now Martin Oduor, the CEO, is taking a knife to costs. In the medium term, I like that a lot. Something like Equity Bank, high growth, high octane stock, trading on a PE of 11. This is the lowest PE I've seen for a very long time. And then I think there's also some interesting shares in the industrial side. These Kenyan companies have moved beyond our borders. They're looking at the region as a whole. You've got this regional impetus happening. And I think there's plenty of value in there as well. The key rider, I would say, is in all these, the information landscape is asymmetric. And there are situations where there are some stocks which, even if they're trading on a P of 4 or 5, they're there for a very good reason. And therefore, I would say, you've got to have some kind of market intelligence on the ground. But overall, this market is extremely cheap. But you do have these legacy issues which need to be dealt with.
Aly-Khan, very quickly, let's just have a look at the fixed income market before we go. Lackluster demand for bonds. In the past 3 weeks, yields have been flat. What are your thoughts on why we've seen this lackluster demand for fixed income products?
I think I would like you to compare Kenya to Nigeria. And I think in Kenya, we had monetary policy which lost its way. It fell behind the curve. A lot of credibility was lost. And essentially, the bond markets are no longer giving the central bank the benefit of the doubt. If you go and look at Nigeria, where he slotted a 50 basis point hike, he stunned everyone with another 75 basis point hike, he got ahead of the market, they got a little bit dizzy, and you've had this enormous fall in bond yields in the last 3 weeks. So I, for one, think it's looking interesting, it's attractive, but I am uncertain about the methodology and the way the central bank has gone about its act in the last 4 to 6 weeks. Until I see a more aggressive stance and an ahead of the curve strategy, I am sidelined on the bond market. But having said that, it's looking attractive, especially for those who want to take some currency exposure. You can get in at 90, you can buy one-year bonds at 10%. And I think that begins to look quite compelling if you're able to look forward. But near term, there's a lot of volatility around the central bank's operations and how they've acted so far.